question we get all the time. The market's gone too far too fast. I should probably wait for a pullback to put my money to work. That works about 0% of the time. If you're a long-term investor, putting money to work every month in your 401k is a great idea. You're going to dollar cost average. You're going to catch some of the highs and some of the lows, and I think that's the way to think about it. But when you think about the market in and of itself and what's driven the move that we've seen so far this year, and arguably since December 24th, it has a lot more to do with things getting incrementally better. The economy has gotten better in a linear fashion. The data in February is better than the data in January. March is better than February. I think that's going to continue this year. I think that multiples on the S&P 500 look relatively full right now if we assume that the earnings are going to look exactly the same for the next 3 months as we've estimated. But obviously, the first quarter is proving that our ability to estimate earnings isn't that great.
Well, that's what I was going to ask you. I mean, it seems to me we began the year with lots of worries about the health of the economy. Well, the economy grew 3.2%. You can nitpick the number if you want, as many have. We were also worried about an earnings recession. Hasn't happened.
Yeah, it's
not so far.
It's interesting. So earnings recessions is a term that we made up because it makes for a good scale.
TV.
It's very good TV.
Very good TV.
Very much like a melt up in the market. And Kelly wrote a great piece on this today, which I love. Now I understand meltdowns because I raised children, so I don't know what a meltdown is, but a melt up just has a negative connotation to it, meaning the market's gone higher for no apparent reason, except for the fact that, to your point, all the things that we talk about as it pertains to the market have actually done better than we thought they would. So the economy's doing better than we thought it would. Earnings are much better than we thought they would be, and the forecast for the rest of this year hasn't moved the estimate for the S&P 500 down for 19 or for 20. So I think that we're just afraid of success here, and I think that feels like there's not enough participation in the market. When you look at both institutional investors and retail investors, their participation in this rally has been poor,
and remains poor.